So you may have heard that the federal estate tax exemption is increasing in 2026. But what does that actually mean for you and your estate plan? Let's talk about who's really affected, what steps high net worth families might want to take, and how gift taxes and state estate taxes come into play. If you're confused by the headlines, you're not alone, and I'm here to break it down for you in plain English. So why does the estate tax exemption change so frequently? Well, really, it's a political issue. Some politicians want to repeal the estate tax altogether. They think it's unfair. Other politicians think the estate tax is useful to reduce wealth inequality and raise revenue. So they want to reduce the exemption amount. And by the way, politicians use the estate tax for fundraising, and it tends to get included in larger budget deals. And I want to mention, we also see this concept of estate tax rules sunsetting. This is because it costs too much usually to pass permanent estate tax laws through the Senate. And so they can only get, say, a 10-year estate tax break through, and then after 10 years it sunsets, or it goes back down to the amount that it was at before. So this keeps us estate planners on our toes, and we want to let you know how this affects your planning. So let me give you a little history of the federal estate tax exemption. It used to be really low. Look, in 2001, the estate tax exemption amount was only $675,000. So that means you could only leave up to that amount to anybody without being subject to estate taxes, and anything above that was taxed at 55%. Yeah, it was really high. But then in 2001, they passed a tax act which would gradually increase the estate tax exemption over 10 years, and then it sunsets. Remember, we talked about that. Then it expires back down to the levels that it was at in 2001. So you see from 2002 to 2009, it went from $1 million all the way up to $3.5 million. And then it sunsetted in 2010. There was actually no estate tax that year. Although there was pretty bad capital gains tax, so don't get too excited. But no estate tax that year. And then there was a budget deal for just 2 years that set the exemption at $5 million at only a 35% estate tax rate. And it also introduced this concept of portability, that somebody could elect portability to transfer their estate tax exemption from the deceased spouse to the surviving spouse. So that's between spouses. All right, so then we get to 2013, and at the end of 2012, I'm saying very, very end, the 2011 law is permanent. All right, so the exemption was set at $5 million and it was indexed for inflation. So by 2013, it was already up to $5.25 million. And the estate tax rate was set then at 40%. And we also had portability that was permanent. So then we see over the next 5 years or so, it goes up and up and up. And then what happens in 2018? Well, we had Trump as our president first time around. And so he doubled the estate tax exemption. But again, it was set to sunset 10 years, right? So it was at 11 point. So it was whatever the year before was doubled, or whatever it should have been that year doubled. Okay, so it was 11.18 million. And you see over the next 10 years, it went up to 13.99 million, which we're in 2025 right now as I'm taping this. But then at the end of 2025, it was supposed to sunset again, back down to half of the amount. So that would have been $7.5 million. But the One Big Beautiful Bill Act was passed, and that actually set the estate tax exemption permanently at $15 million indexed for inflation. All right, so we don't have a sunset now. It's going to keep going up and up, taking into account inflation until Congress does something later. And we just don't know what that might be.
Did you know my mom has a monthly newsletter where she shares helpful information? Click below to join.
So do you need to take steps to protect your estate from federal estate taxes? Probably not. You only need to worry about estate taxes if your estate exceeds the estate tax exemption, which I mentioned in 2026 will be $15 million per person, or if you're a married couple, it'll be $30 million. And it's estimated that only 0.2% of all Americans have this type of wealth. I want to mention something that's a little bit slimy, which politicians have done. They actually call the estate tax the death tax, which I think, is to make people feel like everybody has to pay this tax because everybody dies. But right now, only 0.2% of all Americans are paying this tax, okay? So it's not really a death tax. So if you do have an estate greater than 30 million per couple or 15 million per person, you might want to consider taking steps to reduce or eliminate your estate tax exposure. And I made a video on this called Future Proof Your Legacy: Estate Tax Strategies for 2026. Keep in mind, I made this video before the estate tax exemption was set at 15 million, but the concepts still apply. And let me mention, we don't do this type of high net worth planning at Cookman Law, but we're happy to refer you to somebody who does. Now, how does this relate to gift taxes? Well, if you make a large gift during your lifetime, you're required to report that gift to the IRS on what's called a Form 709, which is a gift tax return. That eats away dollar for dollar towards your estate tax exemption. For example, let's say you give $1 million to an adult child, or you buy them a house for $1 million. The first $19,000 is protected by the annual exclusion, at least in 2025. But the remaining $981,000 has to be reported as a gift, and that decreases your estate tax exemption dollar for dollar. So when you die, instead of having $15 million or whatever it might be that year as your estate tax exemption, you have $14,019,000 of exemption left. You see how that works? You don't get two bites at the same apple. So if you give it away during your lifetime, you also don't get to leave it to somebody at your death. But now I'm going to throw a wrench into everything. If you live in one of these 12 states, including the District of Columbia, you have something called a state estate tax. So that means that above and beyond any federal estate tax you might have to pay, your estate will also be subject to a state estate tax. And the state exemption is usually much lower than the federal exemption. For example, in Oregon, there's an estate tax for all estates over just $1 million. And for Washington State, I understand there's a graduated estate tax for all estates. And for estates over $9 million, the tax rate is 35%. So we have a saying on the West Coast: you should live and work in Washington State, since Washington doesn't have a personal income tax. And then you should go shopping in Oregon, because Oregon doesn't have a sales tax. And then you should die in California, since California doesn't have a state estate tax. Just keep moving south. This is because each state chooses to tax their citizens in their own way. So make sure you understand how things work in your state. So for most families, these changes in 2026 don't really require any action. But if your estate exceeds $15 million as an individual or $30 million as a couple, you may want to explore tax saving strategies in the future. And if you need help understanding how these changes might affect your current estate plan and you're in California, we'd be happy to help.
If this video is helpful for you, share it to someone else who might benefit from it.